Investing like Harvard, taking their cue from the success of Ivy League endowments such as Yale University and Harvard. Some investors are now turning to what's described as the endowment model in order to reduce long-term risks and maximize returns. Joining me now to explain this strategy, we have Scott Kramer. He is the president of the financial planning firm Kramer Rauschager. Good to have you with us.
It's good to be here. Thank you so much.
What is this? Explain this idea of the endowment model. I mean, what makes managing money for a big university like Harvard or Yale different than what regular money managers do?
Sure. The traditional model has been a stock and bond model, 60-40, 70-30. As you get older, you should be moving more money into bonds. What Harvard, Yale, Princeton, and big endowments like that do is they'd have other asset classes besides stocks and bonds, such as real property, institutional quality debt, private equity, venture capital. This has been very proven over a longish period of time, longish being since 1980, and they have absolutely outperformed the market substantively over time. It reduces risk, maximizes return. Small pieces of these different types of asset classes reduce risk and maximize returns.
Now, Scott, is it because these endowments are so big that they have access not only to highly qualified professional money managers, but they can also get into deals, like they can buy timberland, they can invest in venture capital, something that most individuals can't do?
That's right. You know, until recently, this has been largely unavailable to the retail investor. You had to have, $50 million, $100 million. Now, if you have $250,000 as a portfolio, you can have this model. There are these types of investments that have now trickled down to the retail investor.
All right, let's talk about the retail investor just in terms of retirement, because I want to get your thoughts. If there is someone who is retired or is nearing retirement, any strategies that might be available to maximize returns but lessen the downside risk?
Absolutely. This is what our firm specializes in, people who are actually retired or close to retirement. So we do this all day, every day. And the strategy is, if I gave you a model, sequence of returns, if you're withdrawing money, because you're now in the distribution phase, no longer in the accumulation phase, and you withdraw money while you're in a low point or a downturn of a market, it is substantively more harmful to your chances of having long-term money, meaning that it lasts your lifetime. So having these different asset classes that are non-correlated to the market keep you out of trouble, reduce your risk, and maximize your return.
Now, are these non-correlated in asset classes, are they typically more expensive to invest in?
They do have, for the retail investor, the fees are more heavy than in a mutual fund or something like this. However, the performance has been there. So it's kind of one of those things, hey, I don't want to pay those fees, but you do get what you pay for, and there is absolute value in those types of investments.
So people trying to mimic those moves of the endowments, indeed.
Absolutely.
All right. Thank you very much. Scott Kramer joining us from Kramer and Rauschager. Appreciate your insights.
I appreciate you having me. Thanks so much.